Hey y'all, Lee here. Today I got 6 real estate experts here to tell us what their expectations for the real estate market in 2023. If you've never done a deal in real estate, you should watch. If you are sitting on a large amount of inventory or just inventory that you acquire from previous years, you should watch as well. So join us at these 6 real estate experts unload. All right, so first question. As we are entering 2023, the burning questions that every real estate investor has on their mind. What to expect in 2023 for the real estate market?
Well, I'm going to start boring, and then I'll build into it. Well, maybe something a little more than boring. I think 2023 is going to give us exactly what we had in 2022. I think interest rates are going to remain higher than they were, which is the single factor of slowing down sales. I think inventory levels are going to also remain low, which is going to help us a little bit in our sales. So you got this tug of war going on between supply and demand and interest rates, supply and demand and interest rates. You got that tug of war. I think it's going to continue. So far, the interest rate tug has outperformed the supply and demand tug, if that makes sense. Meaning interest rates rose, drove sales down. You had a supply and demand issue that was making it an extreme seller's market. Interest rates goes up, slows that down. So you got the tug of war between interest rates going on versus supply and demand. So far, interest rates has won. Which is not totally would be unexpected. So I think we're going to have that continue through 2023. 2024, I mean, let's just face it, none of us really know. Anybody who says they know, they're just guessing. 2024 is going to be a different animal. I think we could see huge changes come in 2024 because it's going to be driven by elections and Washington trying to, again, manufacture what they want out of the real estate market and the economy. This slowdown of real estate sales, which in the Houston area is about 30%. 30% reduction in sales. They didn't go to zero. We went from about 10,000 sales per month of single-family houses to about 7,000 sales per month in single-family houses. One of the keys is you got to make sure your house, if you're trying to flip a house, sell a house, you got to make sure your house is one of the 7,000 that get sold today. So you got that 2024 coming down the pipe. All of the experts predict interest rates will come down. The supply and demand situation we were in prior to interest rates going up did not go away. It's just the interest rate overrode it, which slowed sales down. So you're still going to have a low supply, high demand if interest rates go back down, which all of the experts predict in 2024. Then you're going to be back to where we were to a certain extent, I believe. And no change that we've had the second half of this year, which is still in effect as of January the 4th, 2023 today. That change is still in effect, meaning sales have slowed down. But you know what, V? I tell people this all the time. Embrace change. Change brings opportunity. Let me finish that sentence. You always hear that. Change brings opportunity. Change brings opportunity in the real estate market for higher profits if you make the right adjustments. So the wild card is going to be what happens in 2024. This interest rate swing that we've had for the past half a year plus was Washington induced. You can argue with me why and how and whatever, but you can't argue with me that it was Washington induced.
I think we continue to go up nationally. I think there will be, real estate is local, and the location just means you have to pay attention to where your property is. There will be some markets that continue to struggle. Affordability will drive that struggle. Ultimately, though, just on the other side of affordability, you have lack of supply really pushing the market up. So supply and demand is undefeated. You will have areas that are down or maybe not going up as fast, but then you could still have some markets that go up 3 to 5% next year in 2023. And I think that's the average of all the economists, as they're expecting a 3 to 4% increase in the median home price in 2023. And so I would agree with that.
Okay, I'm going to be a little bit different than everybody. I'm going to be difficult to work with and say that no matter what happens in 2023, those of us that make our living in real estate, or we're going to do whatever we have to do to be successful. So 2023, it's going to be a good year because that's the only option we've got. It's probably not going to be 2020 or 2021. It might be closer to 2022, things a little bit slower. But we just, like we've talked about so many times, V, we just pivot. We do things differently. So I've been selling some assets that I think are the value is as high as it's going to be, an office building, a warehouse. I don't think that they're going to increase in value over the next few years. So I'm selling them at what I think is the top of the market. And I'm going to take that money and reposition it in 2023, buy some assets that maybe Harris County Appraisal District's not so fond of, where I can get some tax relief, but just get where I can get additional appreciation. So new assets, put them into the portfolio, see what they do for the next 3 years. But big picture, I think 2023 is the year of the savvy investor buying more than selling.
2023 is going to be the year of moderation. It's going to be the year where people kind of come back down to reality, adjust expectations. I don't think we're in any kind of danger at the moment, and I think that we're so far into this already. This correction, we're so far into it now. I think we would have seen evidence of danger or issues on the horizon. I think it's mostly about slowing down, and the velocity of transactions is reduced greatly because of everything that's been going on with interest rates and all that. It's just, I'm calling it the year of moderation. Everybody needs to just cool off, calm down, and wait for what's going to come next. I think the biggest threat in the short term is uncertainty, right? We don't know if the Fed's going to continue doing what they're doing. We're having all these different mixed signals coming back from the economy. Unemployment numbers are still low. The proverbial other shoe hasn't dropped yet. So I think for us, it's a matter of just let's sit back, relax, do what works, apply the fundamentals. But 2023 is going to be a fine ride. It's going to be okay.
Based on the region, different things are happening, right? Some areas that have seen a ton of growth are not growing like they were. Some areas that were doing okay are still doing okay. But, I think the Sun Belt, so to speak, the Texas, Florida, Georgia, that kind of stuff, I think we're somewhat insulated from big swings, right? We don't see the giant crashes that a lot of places see quite as easily. With the way the government is, there's no really way to know. Generally, they mess up things that they try to meddle in, and with the Fed making all these policies, and I think a lot of the things that they do, for instance, raising interest rates, it's an effective way to slow down growth, right? But a lot of the indicators that say, hey, this is working, they're what would be called trailing indicators, right? So something happens, it takes a while for that to take effect. And my fear is, and I don't know anything, so nothing I say probably matters, but my fear is that they're going to make corrections, then they're going to not see the results that they want, so they're going to make a bigger correction and a bigger correction and another correction, and then the trailing indicators come in and they've overcorrected, and then they cause possibly a recession or a bigger downturn than we should have had because they overcorrected. But what happens, I think, then is we have a buying opportunity, right? when real estate takes a dip and we all pile in, and then when they reverse course and start lowering rates because they screwed up and raised them too much, it just fuels the growth even more, and we'll see another nice upswing. Again, I don't know anything, so there's no telling what the government's going to keep doing or not doing. But it's an interesting time. It's different for us, and 2008 when a really big crash came, it kind of blindsided everybody. In this case, we saw the COVID happen. We're seeing all these things changing, and it's happening more gradually. So we're able to kind of continue to tweak our models and modify our businesses to hopefully, thrive during all these uncertain times. And honestly, I don't care a whole lot about anywhere but Greater Houston when it comes to the market, because that's the playground I play in and the one I know. So, if we can hold on through the turmoil, so to speak, with, we still have people moving here every day. We have businesses opening here. We have businesses expanding here. I don't know anything, but I don't see a crash in Houston. We may see, hey, it doesn't go up very much, or it dips a little bit, the values dip a little bit, but right now rents are great. Houses are renting. Houses are still selling. Average costs are still pretty high. They're going up, the average sales price. So we have more inventory today than we did, a year ago, but we have less inventory today than we had pre-COVID.
Obviously, I'm in commercial real estate, so I'll speak on that. I think that rates are going to go up and down. I see rates dropping right now as far as interest rates, maybe not Fed rates, but interest rates for actual loans are dropping now. And they're hovering somewhere around high fives, which is not really that bad. It's actually kind of normal, to be honest. I know people expect them to drop. I don't expect that to drop much more than that. I would be very surprised if it does. But values still seem to be holding up. The market is still there. There are people still buying commercial properties and selling them. So from what I see, the market may slow down a little, but not as much as people expect. I don't think, we're going to be seeing prices after, like we saw in 2009, 2010. I just don't think it's going to happen. Real estate, especially commercial real estate, is now known as more mainstream, as a more kind of mainstream investment to make, and so it's more popular. And because it's more popular, people buy more, and it's becoming more of known as a more solid option than investing in like the stock market or crypto or anything like that. I think that's what keeps up the values. And so, but like I say, it's never a bad time to buy a good deal, right? It's always a good time to buy a good deal. And so you just have to be that much more analytical into the specific properties that you're looking at and buying. You want to make sure to plug in, what your current loan and realistic interest rates are, loan expectations are. So definitely, I think that, we're in for a pretty good 2023. I don't think it's just going to drop out of nowhere. Even in 2008, commercial real estate was actually outperforming residential real estate. So I really think it's a good option, a good stable option if you're interested in investing in real estate at all. I think look closely at commercial real estate as a good viable option to do so.
Question 2. I've been sitting on the sideline for quite some time. Many influencers in the real estate industry are predicting a crash. And with this high interest rate that we got now, should I still get started in real estate investing in 2023? Should I buy real estate in 2023?
Well, the short answer is yes. Now, let me back that up a little bit. I got in real estate investing in 1999, 24 years ago. I thought I came to the party too late. I remember stating in 1999, crap, why didn't I get in this, in the 80s or early 90s instead of 1999? I thought I was to the party too late. I talk about, gosh, we had this huge appreciation of real estate. If I just would have done it earlier. And then here we are 23, 24 years later, coming off the largest 3-year history we've ever had of appreciation in real estate, appreciation of values. For those of us holding a lot of houses, we made a large jump in our net worth and our future cash assets when we sell these properties. I thought I came to the party too late. I promise you, I have never heard a single real estate investor say these words. I wish I would have waited a little longer to get in it. I got in this business in 2016. I wish I would have waited till 2018. You never hear that. You never hear after a big event like we have here in Houston, we have hurricanes. I've never heard a real estate investor say, I wish I would have bought fewer houses when all of these damaged houses are on the market and deals were everywhere. I wish I would have bought fewer. You'd never hear that. So you never, ever hear somebody say, I wish I would have waited. And I think 2022 going into 2023, it's the same thing. It's different timing. You maybe enter in with a little different strategy, but you don't wait. And I think another way to turn that question around is I'm kind of a seasoned veteran, 23, 24 years into this. Am I going to stay in real estate investing in 2023? Am I going to stay in it or get out? Well, the answer is I'm going to stay in it because I think I'm going to know what to do in 2023 to make good, fair margins in my sales and buy good properties I'm going to hold as rentals. I think I have a handle on what I need to do. So if you're new, you still need to get in it. You just need to get yourself educated to where you know what you're doing and where you can make good decisions. And that's the only difference between me and a newbie is I got 23 years of playing time. They don't, but I'm still going to be playing in 2023, I assure you. So we just need to help new young investors get involved. They can come to Jet Lending meetings. They can come to other meetings. They're free and start educating themselves.
There's the old adage, right? You don't wait to buy real estate. You buy real estate and wait. I don't like to throw cliches like that around in jest, but no, I'm buying. I've been doing this for 22 years and I'm buying right now. I feel like I'm not buying in Denver. I'm not buying in Austin. I'm not buying in San Francisco. I may not buy in Miami, but I may buy in Fresno, California, right? I may buy in Colorado Springs. I may buy in the mountain towns that have already seen a 25 to 30% slide in values. I may buy in Dallas for sure. I think, with all the data and information available to investors these days, I think you have to educate yourself and you have to look for the market that fits your need, right? So if you're buying and holding and you have a 5-year window, I say buy anywhere in the nation. You'll be fine, in my opinion. If you're trying to do a quick fix and flip, look at what house values are doing in that zip code over the last 30, 60, 90 days. And if it's pointed down and to the left, you or down and to the right, you probably should not be flipping there. If it's pointed down and to the right, you should probably go in with a really low offer if you're going to buy and hold and go after it. So again, I think, I hate to not answer the question, but the answer to the question is it depends. It depends on where you're buying. It depends on what your strategy is. But in general, I believe it's time to buy.
Well, you're asking a guy that got in the business in 1976. Inflation was 13% and interest rates were 18%. So do I like my line of credit going from 4.5 to 7.5 since January? No. But does it change my overall strategy? No. I'm using my cash a little bit more. It's a balance between my cash and other people's cash, certainly. But we don't really have the option to just sit back and wait for interest rates to come back down. I don't know if they will or they won't. If it goes up to 9, we have to look at it a little bit differently. If it comes back to, 5.5, 6, maybe even a little bit less, that's just a bonus. But, I think the acquisition price is more important right now than interest rates. I think a lot of investors, especially the big groups that are doing large portfolio stuff or doing multifamily deals, hundreds of millions of dollars, they were drunk on 3%. Those are the people that are going to be hurt if they don't have long-term fixed rates. They're not going to be able to service debt, and there's going to be some pain there. But for investors like you or myself or people that we run with that might have, that portfolio of 3 million to 10 million or whatever, you just stay the course. And I don't think that the market rates are going to affect us that negatively. I think it's a buying opportunity for us, because when the market is scared, that's when we do best. So I think the market is scared.
Absolutely. Whether or not you're an investor or you're looking for a property to live in, I think arguably some folks are getting the best deals now, right? And we're seeing sellers willing to negotiate far more often, even on the retail side, concessions and coming in under asking. And we don't know if this is a result of people's emotional reaction to what's happening. So you don't know if this is going to last through the rest of the year. So if you have the option to buy. And if we zoom out a little bit and we look at the last 50 years of the real estate market in this country, it's never lost. So if you can buy, go ahead and buy. And it makes sense, go ahead and buy. We all know that it takes everything to kind of come together at once to become a buyer, right? To be able to actually buy a property. So if you've got that option, exercise your option, okay? Go ahead and buy a house. Don't worry about it.
Should I get sold or not? So if it's a yes or no question, the answer is yes. But that being said, you should obviously be very conservative. Are you going to buy a deal to wholesale? Are you going to buy a deal to hold and rent? Are you going to buy a deal to fix and flip? Are you going to buy a short-term rental? All those questions would have to be, asked to decide if the answer is yes or no for that situation. I think for wholesale, as long as you're real comfortable with what current values are today, and you pay the right amount, you can wholesale. If you are going to retail something, as long as you're conservative and you make sure your repairs are right, because repairs are way higher now than they were, I don't see a problem. Short-term rentals, I could see some risk in some of the resort areas maybe with values, but I don't really see a demand risk for the actual property. So I feel like a short-term rental might still be okay, because as long as you're buying in a place with high demand for that short-term rental, you're not worried that the asset doesn't appreciate the first couple of years, right? It may go down a little bit the first couple of years or whatever. Resort properties tend to be affected by negative news faster than, your bread and butter 322 in the suburbs. If you're going to buy a rental, man, it's a no-brainer as long as you buy it right and you can cash flow right away. If it doesn't appreciate, which is what you want, if it doesn't appreciate, it's not the end of the world. It's just not as ideal as it was before.
I've always been a fan of saying the truth, which is that it is a little riskier to invest in residential rather than commercial, especially if you're looking to have cash flow. It is very, very hard to attain cash flow in residential without having a large portfolio. And then even if you have a large residential portfolio, that means that your head is kind of everywhere. Your maintenance is all going all around. Your management is going all around. I still to this day have not met somebody that doesn't own a large residential portfolio that doesn't want to get into commercial, because that's what they realize after some time. And so the good news is you can skip all that. And I know it's contrarian for me to say that, just go ahead and skip, your house flipping and stuff like that. If you know construction, if you know what stuff should cost, go straight into commercial. And the good news is you can start small as well. You can get a fourplex and then make your way up from there and branch out to shopping centers or self-storage or whatever have you. I just think there is a false notion amongst gurus and people who are leaders in the industry saying you should start and only stay in residential. That's false. I mean, you should know that it does require a little more capital, a little more knowledge, So I think you should just wait. If you don't have the capital to start, just wait or partner with somebody else who does, A lot of the times that people become successful in commercial, they start out by partnering with somebody else that actually has the capital or owners or has the knowledge to do what they do. And so that's a great way to start. I mean, yes, I am a fan of doing everything yourself, but I am also a fan that when you're starting out, learning as much as you can. And sometimes learning as much as you can means partnering up with other people so that eventually you can go your own way and that you're able to buy your own deals.
Question 3. In your opinion, what challenges are new real estate investor faced with today that may not have existed when you started?
Taking bad advice. Surround yourself. Have your team around you of successful people. None of us can do this by ourselves. None of us. I have my own vendor crews that I rely on, to give me advice when I need it or to help me when I need it. And it's people that are established in the business. I got the best title company in Houston. I've got the best roofer in Houston. I've got the best insurance guy in Houston. And all of these people, you meet them at industry events. You have thrown events. We throw a lot of events. A lot of our friends throw a lot of events. Start going to these events and figure out through your probing and asking people for referrals, who knows what they're doing in this business, and surround yourself with them.
So I'm an old man, and we learned to do what was called math on paper. And a lot of new investors, they don't know how to do math. They don't know how to run the numbers. All they know is lazy math. They know a percent ARV or a BRRRR strategy. And so I think, my advice is you have to get good at the math, and you have to have a plan, and you have to know what you're trying to accomplish. And just remember, at a time like this, your emotions will lie to you. You may be fearful when you shouldn't. You may be optimistic when you shouldn't be. But the math won't lie. So follow the math, follow the numbers, and trust yourself.
Hey, you heard Tim. He said you got to know fundamental real estate math, and we did an episode on this as well. So check it out.
The internet helps and it hurts. There's more exposure for your properties, but then there's more people that are competing to buy it. You've got all these buyer groups, you've got equity funds. So, that's an issue. 2 new challenges in the last 2 or 3 years. Property taxes are out of control, and we don't really have a way to control them. We can protest, but we're unsuccessful. And then the other issue that's come up, especially in multifamily and commercial, is being able to find insurance and then make it affordable insurance. I know of a lot of people that are struggling in that arena getting insurance. If you've got a mortgage, it's harder to cash flow. And a lot of my properties are free and clear now, which is nice, but it's frustrating that, a few years back, you could cover your taxes and insurance by a month's worth of rent. Now it's taking almost 4 months of rent to cover the taxes and insurance. So that's what's made me sell some assets here and move them to the country where things are a little bit cheaper right now.
I think that if you're a new investor entering the market, you have the benefit of not having all that head trash that we're all currently dealing with. So it's a blank slate for you. So just I would say this advice applies no matter when you're entering the market. If you're new, trust the fundamentals, trust the basics. Find yourself a mentor. Find yourself somebody who's been doing this a long time. Align yourself with a group, an organization, something where you can rely on their expertise and and that helps shorten the learning curve and hopefully helps you avoid learning things the hard way, right? So I would give you that advice. I would say just be patient with things and understand that what happened yesterday doesn't apply today. So I think the days of slam dunk flips and profits through the roof and all that stuff, for a while, it's kind of be gone. Like, it was glamorous there again for a minute, right? It was cool. It's not right now. There's nothing sexy about being a real estate investor right now. So they will, right? Like, it will come back. It's not if, it's will, it's when, right? So just approach it from that perspective, and just be careful out there, right? Like, I don't want to see anybody getting hurt.
The biggest challenge today is the market is full of investors, right? We've seen it change over the last 10 years from, hey, you go out and buy some houses and you flip them or wholesale them or what have you, to you're fighting against highly sophisticated Wall Street backed money that's very sophisticated in Google, direct dialing, all types of media. They're really, really, really good at getting the leads and getting the property. So the landscape is so much more competitive today than it was 10 or 15 years ago. That's the biggest challenge that I've seen in real estate. And, for somebody that wants to dabble in real estate, their best bet is, shop wholesale, shop MLS, find a deal that they can get, because it's unless you're going to build a machine to be a full-blown investment company like you've done and a lot of people we know have done, you can't compete with these guys. You can't get the deals. You're not going to be able to compete unless you do this full time. If that makes any sense.
I think the challenges are there. I think property, I started 13 years ago, in 2000 and, 2010 and 2011. So we were just coming out of the recession. And so for when I started, I think there was cheaper property everywhere. But everybody kind of thought back then, as they do now, oh, it's going to get worse. It's going to get worse. It's going to get worse. And I'm saying that I've been hearing that for the last, 10 years or so. But one thing, looking back, obviously, looking back into all my 10 years and vision being 2020, we know for a fact that property was cheap back then, very cheap, and it did not get worse. It got a lot better. We actually had an additional almost 8 years of growth, which was unprecedented. Back when I started, property was maybe worth, and they were selling property at $15,000 a unit, $20,000 a unit in Class C in Houston. Well, now you'd be lucky to find $50,000 a unit, And so that alone will tell you we've had a lot of growth. And so, yes, property is still, I guess, more expensive. But if I was, if I was estimating the future, then I would say that the properties are going to keep on going up. Cap rates can still drop, especially in Houston and other cities like that. And they can match the cap rates going on in Los Angeles, New York, Miami, Austin, they're very lower. So, that means that the lower the cap rates go, the more the properties are going to appreciate. And so I think, yes, the best time to buy real estate was 20 years ago, but the second best time to buy it is now. And I fully believe that.
Question 4. I acquired a bunch of properties prior to 2023. I paid top dollars for them. I am now sitting on inventory. What do I do?
I've had this same question many times over the years. I reflect back to the 08, 09, 10 when sales you couldn't sell them very well. You must make 2 or 3 adjustments. Number one, if you have inventory you can't sell without taking a loss, my number one advice is get that property into long-term financing if it's not already in long-term financing, and rent it. I say this all the time. You rent your way out of a bad deal. I've done it. a lot. You can do that. Number two, learn other exit strategies other than just the typical, put it on MLS. One of those, we could talk about this for hours, but one of those is owner finance. But you got to learn how to do it. Okay. Number three, if you can exit a house and break even at this point, even though you don't want to break even, do it. Especially, and I'll use Houston, Texas numbers. If that ARV, your sales price, is north of 300, you do it, and you do it fast. If it's on the lower end, if you're 200 or less, I think you got to take a look in the mirror and look at your house with a magnifying glass and say, why is that house not selling? Because, those houses are somewhat, the house I'm talking about, under 200,000, probably under 250 in Houston, Texas. They're somewhat recession proof to a certain extent. If you have a house on the market for less than 250 and it's not selling, you need to ask yourself why and get somebody else's opinion if you can't figure it out. Why is that house not selling? Because even today, that house should sell. North of 300, if you get the opportunity to exit and break even or close to break even, do it.
Be honest with yourself. There's Blackstone, when I worked with them at B2R Finance, they shared with me that nobody can be right all the time. And this market we've all experienced for the last 2 years, it's been lying to you. It made you think you were better at certain things than you really are, right? The market has been tricking you and other investors. So the best thing you can do is be honest with yourself. So run comps as if you're buying that house today. And, what we see a lot as a lender is someone says, I'm going to refinance this house. I want a 75% loan and it's worth 400. Well, they've had it on the market for 4 months for 400 and nobody's paid 400. That house ain't worth 400, right? It's a $350,000 house now. It was 400 in May when they bought it. So the point is, be honest with yourself. If you're sitting on inventory, stop letting your ego cost you money. The best thing you could do would be start at zero. I used to coach Little League football, and in Little League football, we always, no matter what the score was at halftime, you came out and you said, all right, it's 0-0, right? It's time to, play like the game just started. And I think that's what you have to do with houses. You have to, sit back, run comps on them based off today's numbers, double check your pricing. Real estate sales always comes down to the 3 Ps: pricing, product, and presentation, right? So double check your pricing, make sure the product you have, make sure the price is right for the product you have, and then make sure it's properly presented. Any moron with an MLS login could sell a house in the last 3 years. Now it may take a little bit of skill. So make sure you have a good professional realtor on your team that can help you sell the house and make sure it's presented properly to the public.
Well, I think that you need to keep those properties leased. Maybe, let's say you're used to getting $2,000 a month and you can only get $1,700 a month, and you need to take it. You need to minimize, the run on your cash. The market's going to come back. It just depends. I mean, there's so much money in Houston, Texas. There's a lot of people out there that have so much money they don't know that we've got inflation. They don't know that interest rates are up. So if they want a property that you're selling, they're going to buy it. So I would put all of my properties that were vacant on the market as for sale or for lease, and whatever appears first, that's the best deal for me, then that's what I'll do. Or let's say I think something's worth $200,000 and that's what I want for it, but the market's telling me it's only worth 180. I might sell it for 200 and owner finance it, and maybe make 10, 11, 12% on the owner financing. So I feel like I'm, getting some of my money back. It's a little, it helps me feel better about the deal, but you can't keep all your inventory all the time. The ones that I'm paying the highest property taxes, so my return gets lower and lower every year. They're on the market and they're good properties, so somebody's going to pay me a fair price for it because they want to live there. And so I just, you got to turn your inventory and then take that money somewhere else where you can buy in cheaper and have an asset that you think is going to appreciate over the next few years.
That's a tough situation. Okay. I know a lot of us have found ourselves in a situation like that. I know we did, not on our whole portfolio, but on a few cases, right? But for those that have found themselves in that situation, they need to really take a sobering look at the reality of what's going on, and don't be afraid to negotiate down to wherever it needs to go, reduce the price, offer the concessions, and make sure that you are not emotionally attached to the property, right? If there's going to be some sort of a loss, it's okay. Live to fight another day. But if you think you're going to hold on to these things and something miraculous is going to happen and it's going to turn around and I'm going to make that magical money I thought I was going to make, get over it. It ain't going to happen. Okay. Unless you can pay the note on that thing for another 24 months, you might be able to rebound a little bit, but new market, new numbers don't apply to the old market and the old buys. Get rid of it. That's your goal.
Okay, so you heard from all the experts. Here's a quick recap. No crash in 2023. Let's recap number 1. 2, evaluate the deal before you write the check. 3, it sounds like a cliche, but always the right time to get into real estate. 4, cut your losses when necessary. It's like that time where you gotta make that tough decision to cut off a limb so you can live and fight another day. And 5, and lastly, if you are a seasoned investor, you should learn multiple exit strategies. Okay, so by the way, if you enjoyed this episode, you should watch this other episode that we did an interview with Rich Drake. Thank you so much for watching. See you in the next video.